Q1 performance update. Financial performance assets under management grew by 20.43% year-on-year, reaching 12,505 crore rupees. Profit after tax rose 19% year-on-year to 84 crores. Total income increased 28%, from 347 crores to 444 crores. Return on assets remained healthy at 2.84%. Return on equity stood at 14% on an expanded capital base. Management is confident of maintaining net interest margins between 7 and 8%, supported by a favorable asset mix. Business and operational highlights. The company marked its 30th anniversary, celebrating resilience and consistency. The MSME segment remains the core focus, contributing about 75% of assets. The salaried personal loan book grew 92% year-on-year, reaching 1,131 crores. It now makes up just under 10% of total assets, in line with company guidance. Distribution mix is currently 65% retail and 35% NBFC partners. The company targets a 70-30 split in favor of retail within the next 6 to 12 quarters. Operating expenses increased due to upfront investments in expanding retail infrastructure, though overall return on assets remains intact. The branch network stands at 206, with further expansion planned in the second half of the year. Asset quality gross Stage 3 assets were stable at 2.49%, while net Stage 3 stood at 1.63%. A provision buffer of 17.6 crores is maintained, which is about 0.17% of on-book assets. The commercial vehicle portfolio shows some stress, with Stage 3 assets around 4%. Disbursements here remain cautious. Management noted that while macro deterioration has halted, meaningful recovery may take another quarter or two. Housing finance subsidiary assets under management grew 27.4% year-on-year, reaching 794 crores, close to the 1,000 crore milestone. Profit after tax rose 27% to 2.76 crores. Asset quality remains excellent, with gross Stage 3 at 0.92% and net Stage 3 at 0.64%. Liability and capital management. The capital adequacy ratio is strong at 25.22%, with Tier 1 at 23.19%. Average cost of borrowing was 9.8% for the quarter. Management expects a reduction of 25 to 35 basis points for the full year as rate cuts take effect. Liquidity is ample, with sanctioned facilities of 2,200 crores and a healthy pipeline of term loans and NCDs. Guidance and outlook. The company reiterated its guidance of 20 to 25% annual growth, with focus on asset quality. Management aims to add the next 13,000 crores to AUM within 3 years. Growth will be driven mainly by MSME and wheel segments, with a pilot on used car loans underway. Stronger momentum is expected in quarters 3 and 4, supporting the full-year target.